Hello everyone, good morning and welcome to today's lecture. So today we are going to cover chapter 11. Okay, now what is chapter 11 about and what it deals with? So chapter 11 talks about three important SAE, three important standards. These are the standards on assurance engagement. Now what these standards are about and why we need a standard on assurance engagement. Basically, see, till now what we were doing is auditing historical financial information, auditing entering financial information, okay, agreed upon procedures, okay, review engagement with a limited assurance. But now we will be seeing specific scenarios where either we are examining the prospective financial information, not the historical one. Either we are issuing an assurance report at the control of the service organization, the way we have SA 402. On the similar lines, we have a SAE 3402. Or either we are issuing, examination report on the compilation of proforma financial information, which is included in the prospectus. So we have a specific kind of scenarios to discuss wherein we are issuing reports, okay, with respect to specific kind of engagements. And for those specific kind of engagements, we have a standards on assurance engagement, which we usually call it SAE. So we have a SAE 3400, 3402, and 3420. Okay. Now, when I talk about, let's start with the SAE 3400. Okay. Because all the three are different and, not related to one another. Let's start with the SAE 3400. Now, when I talk about SAE 3400, okay, what it talks about, like what is based upon. So SAE 3400 is a standard which deals, okay, or which establish or provides the guidance on the engagement to examine and report on the prospective financial information. Like a prospective financial information may include your best estimate and hypothetical assumptions, but for that we have a standard 3400, SAE 3400. Okay. Now, usually it doesn't apply to the examination of a prospective information with respect to, such, which are found, generally or in narrative terms. Let's say, for example, management discussions or some management annual report, some forecast prepared by the management. No, that is not applicable in those cases. It is applicable when we are, examining the prospective financial information specifically prepared for this particular engagement. And we'll discuss what is that. Okay. Now, what is prospective financial information? That is the first thing we need to understand. Okay. Prospective financial information. Now, till now, we were talking about historical financial information. Everywhere we were referring to historical financial information, data of past transactions, data pertaining to transactions already happened. But when I talk about prospective financial information, it is something that is going to happen in future. That is not yet occurred, but that is going to happen in future. And the assumptions about those events that are going to happen in future, estimates about those events that is going to happen in future is prospective financial information. It could be a forecast, it could be a projection, or a combination of both. Okay. So I could say a prospective financial information may have a forecast, may have a projection, or a combination of both. Okay. Now, when I talk about forecast, basically it's kind of, based on the assumptions as to future events which management is expecting to take place. Okay. Based on the, the data and the information we have available with us, kind of a best estimates assumptions, you can say. But when I talk about a projection, projection is also about future events, but it is not necessarily expected to take place. Okay. kind of, you can say forecast is about, best estimate that we have a higher chances of occurring. Projection kind of a, estimate with a less chances of occurring. So forecast when management thinks that, these events will definitely take place in the future or expects to take place in the future. Okay. But when I talk about projection, it is kind of, which are not necessarily expected to take place. They may not be. Okay. So the probability is less with respect to a projection. Now the projection can be a best estimate, which is again used in the forecast, and a hypothetical assumptions. Hypothetical assumptions kind of, same thing, that is may happen, may not happen. And best estimate, when I say, it's a thing that, okay, that has a higher chances of happening in future. So forecast means a prospective financial information prepared on the basis of assumption as to future events which management expects to take place, and the action management expects to take as the date of the information is prepared. Okay. So kind of a best estimate assumption. But when I talk about projection, the projection is something which is a hypothetical assumption about the future events and management actions which are not necessarily expected to take place. Now, this is a very important point that I was talking about. Not necessarily expected to take place. Reason, because in projection, the probability is less. That's why it's a projection. Okay. That's why it's a projection or called as an hypothetical assumption. Now, again, a projection can be a mixture of best estimate. When I talk about best estimate, it goes to the forecast. Generally, we use best estimate in the forecast. And a hypothetical assumption. Hypothetical assumption means this one with a less probability of occurrence. Okay, so that is the difference between forecast and projection. These both together are known as a prospective financial information. So prospective financial information can be a forecast or a projection or a combination of both. Clear till now? Okay. Now scope of SAE 3400. Now, as I told you, the purpose of this particular standard here is pretty much clear, pretty much simple. That it provides the guidance with respect to examination and issuance of report on the prospective financial information, including examination for best estimate and hypothetical assumptions. Okay. Now, again, we have already discussed what is best estimate and hypothetical assumptions. Best estimate, higher chances, hypothetical assumptions, lower chances. However, as I discussed, this SAE will not be applicable to all the estimates, forecast, assumptions prepared by the management, disclosed by the management. No. So if some forecast or assumptions management has, casually disclosed or narratively included in their annual report or in their some other report, okay, in that case, that particular will not be covered by this standard. Let's say, for example, in annual report, management has given, okay, next year we are estimating 10% increase in our revenue. That is just a narrative terms that management has provided 10% increase. Now that particular 10% increase, can I bring that particular information of 10% increase under the purview of SAE engagements? Answer is no, because to have this engagement, the auditor requires certain things. To have this engagement, first of all, auditor is required to obtain sufficient and appropriate evidence with respect to whether the management best estimates assumptions, like whatever assumptions management has taken, whether in the best estimate or whether on the hypothetical assumptions is not unreasonable. So we need a backup. We need detailed data basis on which the assumptions have been taken. Second, the prospective financial information is properly prepared on the basis of those assumptions. Third, the prospective financial information is presented, okay, and all material assumptions are adequately disclosed, including a clear indication as to whether they are best estimate or hypothetical assumptions. If all these three things are there, then I could say, okay, I can, perform this particular engagement and this engagement or this on this particular report or data. Okay. Any doubt till now? Any doubt? Again, here the management will be responsible for preparation and presentation of prospective financial information. We are not responsible at all. Management is responsible for preparation and presentation of a prospective financial information. Okay. Now, as you are already aware, okay, this particular prospective report on the prospective financial information in professional ethics, we saw that if a chartered accountant in practice, okay, certifies future events, or if he certifies something which is not of the historical financial information, then he can be liable for the professional misconduct. Remember something like that? Remember that we discussed in professional ethics. Anyone, if anyone can recall and give me that particular clause number. Come on, quickly. If anyone can give me that clause number which I'm talking about. Come on. Very good to that. Come on, guys, come on. Which clause it was? Remember clause 3, second schedule, part 1. If a CA in practice permits his name and the name of the firm to be used in connection with an estimate of earnings that are contingent upon future transactions, okay, or the name is used in a manner that is leading to believe that he or his firms are vouching for the accuracy of forecast. In that case, he will be held liable for the professional misconduct. Remember something like that. Now, if I talk about this particular clause, okay, then basically, if you see, if I talk about that particular clause that says that we cannot vouch the accuracy of the forecast, but here we have the engagement, we have the standard. Then how both are different? Here we are not vouching First of all, understand, we are not vouching for the accuracy of a forecast. No. What we are saying is that management best estimate assumptions on which the prospective financial information is based are not unreasonable. I'm not talking about the accuracy because I myself bifurcated the assumptions in two categories, the forecast and in two categories, forecast and projection. When I talk about forecast, it's the best estimate assumption. When I talk about projection, it's a hypothetical assumption. So I'm not saying that I vouch for the accuracy, but I only say that when I talk about best estimate assumption, I say they are not unreasonable. And when I talk about hypothetical assumptions, I say these assumptions are consistent with the in purpose of the information. So I'm not vouching accuracy of a forecast. Okay. I'm not vouching accuracy of a forecast. Okay. Second, so there is one doubt with respect to this particular paragraph. See, now which information can we say that it is an information which can be included as a part of the engagement prospective financial information? There could be a lot of prospective financial information in management documents. For example, in annual report, you have a one simple liner that management expects increase of 10% revenue next year. Okay. In that case, if you have such a line in annual return, can I call that as a prospective financial information? Answer is no. Okay. Because this particular essay specifically says that, that SAE 3400 will not be applicable. Will not be applicable. Okay. To any prospective financial information expressed in the general or narrative terms. Because in annual report, if you talk about, it is only written, okay, 10% increase. That is a general or narrative term found in the management discussions or analysis in an entity annual report. But this will apply only where you have a, supporting available, background available of the information, whether it's a best estimate, whether it's a hypothetical assumption, the basis for best estimate or hypothetical assumption, and a detailed, analysis of that. Okay. If you have all these things, then only this will apply. So it is not on the casual prospective financial information, I would say rather a detailed financial prospective financial information where you have, basis for the assumptions, where you have whether the, prospective financial information is appropriately disclosed or not based on the assumptions. You have, properly presented all the material assumptions with the prospective financial information, clear indications whether they are the best estimate or the hypothetical assumptions. And when the prospective financial information is prepared on the consistent basis with the historical financial statement using appropriate accounting principles. If all these things are together, then only I would say, yeah, this is a prospective financial information which could be brought under the purview of SAE 3400. Clear? Any doubt? Any doubt? Okay. I will be using the term auditor throughout this particular SAE. Okay. It may or may not be, but I will be using this particular term as an auditor. Now, again, prospective financial information, as I told you, relates to the events and actions that have yet not occurred or might not occur. Okay. So this is a future oriented, future based data, events, transactions that are predicted or through best estimate or hypothetical assumptions. Okay. Therefore, as a result, okay, auditor is not in a position to express an opinion whether the results shown in the prospective financial information will be achieved. No, that is not our role. Neither we will give this opinion. We will not give an opinion that okay, these prospective financial information okay will be achieved or can or cannot be achieved. Okay, so if you give this kind of opinion that okay, we opine that the prospective financial information or the forecast or the projection appears to be appropriate and management will be able to achieve that in future, then that will be wrong. No, we are not required to provide this kind of opinion. Okay, so no opinion on the achievement of the forecast. However, based on the type of evidence available in assessing the assumptions, okay, on the forecast, on the prospective financial information, it may be difficult for the auditor to obtain level of satisfaction sufficient to provide a positive expression of opinion. Okay, positive expression of opinion. So then in that case, auditor needs to evaluate whether he can issue a positive expression of opinion, means in opinion in a positive terms, not a negative term. The way we have we have seen in the case of review engagements, the negative way of expression of opinion. Unlike that, if the auditor, auditor has to issue the positive one, but if he feels he cannot, then he needs to assess the situation. Again, when here we are talking about moderate level of assurance. Okay, moderate level of assurance. Fine. So the next part I want to discuss now. Again, when I talk about any engagement with respect to prospective financial information, all the things will come into the picture. Like acceptance of the engagement, knowledge of the business, period cover, or again the procedures that are required to be performed. Everything will be there. Everything in the picture. Presentation disclosure. Okay. Again, documentation, minimum categories of the items that are required to be reported in a particular report. Everything will be part of that. So we will take one by one, okay, area and we'll discuss in detail. So first is with respect to again accepting the engagement. Okay, agreeing the terms of an engagement. Now, when we talk about this particular engagement, before accepting the engagement to examine the prospective financial information, the auditor is required to see what is the intended use of this particular information prepared by the management. Whether information will be generally available to all or it is the kind of information which is available limited. Nature of the assumptions, whether they are best estimate or hypothetical assumptions. Okay, the elements to be included in the information and the period covered by the information. So auditor has to verify all these things before he can accept the engagement. Now, as I told you already that the clause 3 of second schedule, states that the chartered accountant in practice shall be deemed to be guilty of a professional misconduct. Okay. If he permits his name or name of his firm to be used with an estimate of earnings contingent upon future transactions in a manner which lead to believe that he vouches for the accuracy of a forecast. Okay. In a manner which, uh, may lead to believe that he vouches the accuracy of the forecast. And the point here is accuracy of the forecast. Vouches the accuracy of the forecast. Again, here we are not vouching the accuracy. Before accepting the engagement, the auditor has to make sure that he's not vouching the accuracy. Rather, he is providing a basis, or he's talking about whether the management best estimate assumptions are not reasonable and the hypothetical assumptions are consistent with the purpose of information. I'm not vouching on the accuracy of the forecast. No, that I'm not doing here. Here, I will be specifying the source, the information based on which either best estimate or hypothetical assumption have been taken. I will specify in my report that these are the best estimate or hypothetical assumptions which may not take place in future. That I will include in my report. Okay, so that's why before accepting an engagement, auditor has to make sure that uh, this kind of thing is already agreed, that he's not vouching the accuracy of the forecast. So as I already discussed, that uh, best estimates assumptions are not unreasonable. Okay, and hypothetical assumptions are consistent with the purpose of information. This is the thing that auditor is required to do. And when I talk about best estimate assumptions that are not unreasonable, so I am not again talking about that I will be vouching the accuracy or kind of give an opinion that everything is appropriate, or is as per the correct and true and fair. No, my opinion here is in a different way. I am saying an estimate is not unreasonable. I'm not saying that is inaccurate. No, I'm saying it's not an unreasonable. I say that hypothetical assumptions are consistent with the purpose of the information. I'm not saying they are, even I'm not saying they are unreasonable, because hypothetical assumptions that we have already discussed, it's something it may not happen. So if it may not happen, then how can I say it's a reasonable or unreasonable? Only I can say that, okay, this is consistent with the purpose of the information that has been given to me. I hope you are getting the point. Like the type or thing that we are going to report upon in the final report. We will say that properly whether the prospective financial information is properly prepared on the basis of the assumptions, whether the prospective financial information is properly presented, whether the prospective financial information is prepared on a consistent basis with the historical financial statement using appropriate accounting principles. So I am everywhere talking about prospective financial information, but I am nowhere vouching its accuracy. Any doubt till now? No, we do not give a opinion up on the what you say, on the vouching of accuracy, or on the appropriate on what you say, conclusion that okay, this will happen in future. No, I won't be doing that. I won't be doing that here in this particular engagement. Then what kind of conclusion we will be giving in our report? So the question comes is what kind of conclusion we will be giving in our report. So our report, okay, will basically talk about with respect to the source of the information considered by the management, their adequacy, reliability, underlying data, including data derived from the third parties. Okay, then whether this particular information, whether best estimate or hypothetical assumptions are appropriate in the circumstances or not. For example, we will include a statement with respect to the negative assurance, whether prospective financial information is on best estimates are not unreasonable, and hypothetical assumptions are not are not inappropriate, kind of based on the given data. So here we will use the term opinion only, but in the opinion we will be giving an opinion in a negative form of a negative assurance. Why the level of assurance is moderate, not low? See, why the level of assurance is moderate? Because at the end, I have to verify the data behind the forecast, the data behind the projection. In low level of assurance, I cannot say no, that I am not going to verify, okay, the data behind the projection, the data behind the forecast, or the data behind the assumptions. In low level of assurance, we perform limited procedures. Here, I am not supposed to perform limited procedures. Understand that. My procedures will be full procedures. Okay. They will not be limited in any manner, but they will be directed towards the prospective financial information, the best estimates, the hypothetical assumptions. That's why moderate level of assurance, not a low level of assurance, because at the end I have to perform the procedures in order, to provide that the best estimate are not unreasonable, or to provide that the hypothetical assumptions are appropriate for the purpose of the information. Vouching the accuracy. So how it is different from vouching the accuracy of forecast? Vouching the accuracy means I say that, okay, this forecast, if I vouch the accuracy, I say that this is going to happen in future. So kind of a predicting future with 100% surety, which I cannot do. That is not appropriate. I cannot vouch the accuracy of forecast. I cannot say, okay, this forecast will definitely be achieved, will definitely happen. This event will definitely happen. No, I cannot say that. Otherwise, I will not term that particular thing as a forecast. Can I give assurance to a company or in my report that, okay, the management is saying that next year they will achieve 50%, and I am giving an assurance that, okay, I believe that the management will definitely achieve 50% in next year? Answer is no. I cannot do that. That's why vouching the accuracy of a forecast is incorrect. So the term vouch for the accuracy means that you are saying that the results will be definitely achieved. But when I talk about uh, basis for the forecast or projection, I talk that they are not unreasonable. I talk that, okay, they are appropriate with respect to the information provided. I do not opine on their achievement. Hey, everything is not hypothetical, because see, hypothetical assumption means it may happen, may not happen, 50-50 chances. But when I talk about best estimate assumptions, which is generally your forecast, okay, your forecast is something that that has a higher chances of occurrence. Let's say, for example, 70-80%, but not 100%. I'm talking about 70-80%. So that is a best estimate assumption that I'm saying in the picture. So everything is not hypothetical assumptions. Some things have a higher chance or higher probability of occurrence. So I will classify those things in the bucket of best estimate assumption or a forecast. But if something has a 50-50 chance or lesser chance, which may not happen, I'm not sure about that. I don't have the data to corroborate its occurrence. Okay. In that case, I may call that as a projection. Okay. Any doubt? Any doubt? No? Yeah, kind of, you can say. 2.5 is same as 2.2. There's nothing difference in that. No difference in that. Okay. Now let's talk about that. I was talking about accepting the engagement. Before I accept the engagement, I need to make sure I am checking all these things. Number one, the intended use of the information, the prospective financial information, why it is being prepared, for what purpose it is being prepared, whether the company will give it to the bank, whether the company will issue in the market, where the company will circulate this information. That is something we need to understand. Because if it is for the general public or for the market, then I need to make sure, it should not give wrong picture to the users. I need to make sure that, I have to take all the steps to, make sure that it should not give wrong picture to the users or readers of the information. Let's say, for example, tomorrow company prepares for, this prospective financial information of next 5 years with all the data, relevant disclosures and everything. And they get it, verified, not verified, but they bring it to me and they ask me to issue an opinion on this. I do issue an opinion. Let's say, for example, hypothetical example, I issue an opinion. Now, what will happen is, if the intended use was to distribute in the general public, then it may appear that, company is issuing some information, which is, people will assume that it is audited by the auditor because auditor's name is Bill. Auditor has signed this particular information. So I need to check what is the intended use of the information. It should not be misleading. It should not be the case that, the information is of, presented in such a way that it is assumed by these stakeholders, readers, that something, the auditor is verifying the projection or he's, kind of issuing assurance over the projection. No. Second is whether the information will be for general or limited distribution. Again, with respect to the intended use only. Third, whether the nature of assumptions, okay, whether the nature of uh, that is like, whatever assumptions are there, whether they are the best estimate or hypothetical assumptions. Fourth, the element to be included in the informations. What are the elements that are being included in the informations? What category? How much detailed the prospective financial information is? How much detailed? Okay. The prospective financial information contains the data and the period covered by the prospective financial information, 1 year, 2 year, 5 year projection. So we need to check how much bigger it is, how much longer the period is. See, if I try to make a projection for next 20 years, that will be just, up, like not, what I would say, not at all appropriate. Not at all. Projection for next 20 years. Think about that. Who can project next 20 years? No one. Basically, you won't be even having that data. I can still say that, okay, next 5 years is something the last, I would say, not even the sixth year, because everything changes, like, policy changes. It may have, you have a different government in the picture. Okay, you have a different, targets by the government, policies, the market scenarios, ups and downs in the market, demand, supply, everything changes within the 5 year. If everything changes within the 5 year, then how can I do a projection for more than 5 years? So the period covered by the information is very, very important for us to understand. And this basically, helps us to understand whether we should accept the engagement or we should not accept the engagement. Let's say management asks or management prepares, prospective financial information of next 20 years. I will not accept the engagement. Sorry. Next 20 years, I even cannot, say that, these are not unreasonable. So again, I need to see what is management is preparing, the intended use, whether general or limited distribution, nature of assumptions, elements, and period covered. Now, there are certain examination procedures that I need to follow, okay, in order to gather sufficient and appropriate audit evidence. Now, these are the examination procedures which I need to, perform, which I need to follow, in order to gather sufficient and appropriate audit evidence, not audit evidence, basically only evidence, sufficient and appropriate evidence with respect to the things on the, I need to issue the opinion that they are not unreasonable and they are appropriate in the circumstances. Now, before I proceed with the examination procedures, before I do any examination procedure of the information, I need to gather knowledge. Okay, I need to gather, some information in order to, in order to perform the procedure. So the things which I need to gather are like the knowledge obtained during any previous engagement, which I can use, corroborate, which I can implement in the current engagement. Okay. Second, management's competency regarding the preparation of prospective financial information. Whether management is competent enough to prepare prospective financial information or not. Likelihood of a misstatement in the prospective financial information. The extent to which the prospective financial information will be affected by the management judgment. See, at the end, whether I call it a best estimate assumption or I call it a hypothetical assumption, there are high chances that they will be affected by the management judgment, because at the end, that's a judgment only. That's an estimate only. That's an, some judgments taken by management on the basis of which they have prepared either the best estimate assumption or hypothetical assumption. The source of information considered by the management for purpose of their, preparing this prospective financial information. And when I talk about source, I talk about basically reliability of the data, adequacy of the data, okay, data derived from third party. If the data has been derived from the third party, then which third party, like industry statistics or some other kind of survey has been done, report has been published to support the assumptions. Stability of the business. Now that is a very important point, stability. Let's say, for example, management has prepared prospective financial information. If you see the last 5 years of the management, okay, and the financial information, historical financial information, you will feel that management is not able to meet their target. The management is not able to meet its target, okay, during last 5 years. Means there were sometimes high, there was sometimes low. So some years were good for management, some years were pretty bad for the management. So there was a lot of fluctuation. Okay. Just if I give you one example, let's say, okay, like this is, I'll just talk about few things: revenue, okay, profit, two things, particulars. Let's say year 1, year 2, year 3, year 4, and year 5. Okay. Now let's say in year 1 revenue was 100, here it was 110, here it was 80, here it was 70, here is 120. Same way, I have on 100 I have a profit of 20, on 110 I have a profit of 20, on 80 I have a profit of 15, on 70 I have a profit of again 18, on 120 I have a profit of 10. Let's say this is a kind of scenario. Now coming to year 6, these are the projections, prospective. Let's say year 6, year 7, and year 8. If I see the historical financial information, I can say this is not stable. management is not stable. The business of the entity is not stable. If that is not stable, how can you predict 6, 7, and 8? How can you do assumption for 6, 7, and 8? If it would have been, let's say, year 1, year 2, year 3, year 4, and year 5. If it would have been like this 100, 105, 1110, 1112, 1115. So for year 6, 7, and year 8, I could have seen, okay, like not 115, but it will be something more. It could be 118, reasonable, 122, reasonable, 125, reasonable, because it's an increasing trend. So I could see a trend here. Means business is stable. I can see a trend, it's stable. But here there is no trend. Like it is going up, then down, up. And again with the profit, if you see, profit is also not stable, profit percentage. Nothing is stable. In that case, it is very difficult to prepare a prospective financial information and that to support with the data and assumption. So that's why it's very important to understand whether their entity is business stable or not. Stability of the entity business. Then the engagement team's experience with the business and the industry in which the entity operates with the reporting on the prospective financial information. You guys tell me why, experience of the industry or how the industry will impact prospective financial information. How the industry will impact, like, in which the entity is operating, prospective financial information. Come on. How industry is relevant over here? Come on, guys. How industry is relevant over here? Come on. Why management team's experience with the business and the industry in which entity operates is relevant? Why do you think it's a relevant one? Come on, quickly, guys. Correct, Robin. Correct, Mancha. Yes, Mohammed, very good. Let's say, for example, I talk about cement industry. Okay, they have a different market category, cement industry. Okay, but they, having a different market category, they also have a different ups and downs in their industry. Okay, their demand cycle, their cycle of business is different compared to what I can say in IT. In IT, I can see a growth of 25. So a growth of 25% can be achieved in IT industry. But a growth of 25% revenue may not be possible in a cement industry unless and until it's a monopolistic or monopoly market. So industry is very, very important. For example, aviation industry. Very difficult to think about growth. Very difficult to think about growth. So I cannot assume that if it is the aviation industry, then I would say, okay, 20%, 30% growth for the next 5 years. No. So industry plays an important role. Clear? Clear? Any doubt till now? Yes, Tanisha, absolutely correct. Any doubt, guys, till now? Okay. Now, there are few things that I need to check with the presentation and disclosure of the prospective financial information. So, whenever prospective financial information is presented, okay, I need to make sure that is presented with the underlying assumptions. I need to check whether there's a specific requirement of any relevant statute, regulation, as well as the professional pronouncement. Okay. So that, let's say, for example, if there is a requirement that prospective financial information should be presented with a heading that this is a prospective financial information, not the historical financial information. Okay. And if management, removes that particular heading or something like that, then it could be misleading. In that case, I need to make sure that, the presentation of prospective financial information is informative, not misleading. The accounting policies are clearly disclosed in the notes to the prospective financial information. Now, one question I would ask, why we are talking about accounting policies? How accounting policies will be important when we are talking about prospective financial information? Why we need accounting policies with respect to prospective financial information? Mansha, so company's culture is kind of already be included in the management competency. When you talk about company's culture, somewhere you talk about competency of the management. So, Kumar, in your example that you are giving, that the state electricity distribution utilities have to submit 5-year plan to the state electricity regulatory commission under a statute. Now the question comes is, can that be covered under this standard? So the first question is, are they required to get an opinion from a chartered accountant on that particular information? Because what I know is that is not a certified, or that is not a such kind of information which is given to a chartered accountant for his opinion about the estimates. It is directly submitted by the authority. It is directly submitted by the discoms to the regulatory commission. So there is no role of the chartered accountant in that. Okay, coming back to this, my question is, how accounting policies are important and relevant with respect to prospective financial information? Simple. How accounting policies are important and relevant? Where will you use accounting policy when we talk about prospective financial information? Where? Come on, guys. Where you will use accounting policy? Okay, Tanisha. Very good. Okay, Suraj. But do you think that accounting policies are useful while making assumptions, whether it's a best estimate assumption or a hypothetical assumption? Do you think that accounting policies are important while making these assumptions? What do you say? So, yes, correct, Robin. Correct, Suraj. So, yes, assumptions are not only made based on the the data, but they are also made based on the accounting policies. Okay. For example, if you have a, let's say the company is following percentage of completion method of accounting, okay, with respect to revenue recognition, then when they will make assumption, they cannot just make assumption, okay, this year it was 100 rupees revenue, next year it will be a 10% increase. No, they have, when usually when a prospective financial information is prepared, it is not prepared just by having a 10% increase, 12% increase, and just saying that that's an average increase. No, they are prepared on a minute and very, very detailed level. They go on a customer level, they go on, very much segment level. What will be the segment income? What will be the segment expense? Increase in the income will also lead to increase in datas. Datas will require provision, it may require provision, collection, everything is linked. Everything. Then from provision or from data, there will be a collection. So bank balance projections and everything, cash flow projections, from cash flow to expenditure to vendors to creditors to liabilities. Okay. And when I talk about expenditure, then my profits, then it goes to the, again, if I'm trying to achieve a kind of a revenue where, which is not feasible with my current capacity, I may need to do additional investment. So if I talk about additional investment, then projection for the fixed assets, their depreciation. And if I talk about additional investment, I need to see the funds arrangement, cash flow arrangement. If I don't have the cash flow, then the projection with respect to the loans, liability, their interest, their repayment, everything will flow in detail with respect to the accounting policies. Even I do projection of the tax, provision for tax, deferred tax, okay, deferred tax asset or deferred tax liability. So everything works based on the accounting policy. It's not just a simple, that I say, okay, 10% increase, 12% increase. No, it is a detailed working that is prepared in actual. And tomorrow I cannot say that, okay, I have prepared on the cash basis. I assume that this much cash I'm going to receive, and that's the revenue increase I'm expecting. No. So somewhere I have to make sure that, I am following the appropriate accounting policies also when I'm making the projection. Okay. Then whether the assumptions are adequately disclosed in the notes to the prospective financial information. Okay. It needs to be clear whether the assumptions represent management best estimate or hypothetical assumptions. And when the assumptions are made in the area that are material and subject to high degree of uncertainty, this uncertainty and resulting sensitivity of the results needs to be adequately disclosed. When I talk about sensitivity, have you heard about sensitivity analysis? You might have read about sensitivity analysis. Anyone, whether you have you read about the sensitivity analysis? Yes, correct, Tanisha. Yes. Okay. So here also we do sensitivity analysis because these are the estimates. These are the either best estimate or hypothetical assumptions. So we pick up the material area and we actually disclose that, okay, if there is a 1% or 5% or 10% change in the area, then what will be the impact on the revenue? If it is not the revenue, then profit or on the other areas. So sensitivity analysis is done for the material areas which are subject to high degree of uncertainty. Establishing point in a range that should be clearly indicated. Okay. And the range is not selected in a biased or a misleading manner when the results and the prospective financial information are expressed in terms of range. Okay. So Sometimes, management will provide prospective financial information in range. Let's say they are estimating, revenue to increase from, let's say 100 rupees to 120, anything between that. So a clear indication that, that the range is not biased and misleading. Okay. The range which has been taken, okay, and the points of the range which are, considered for the purpose of the historical financial information are not misleading or biased. Then if there is any change in accounting policy that the entity, is expecting or to apply the change in the prospective financial information, then the reason for the change and effect of such change. These are the things that are required to be disclosed with your prospective financial information, and this is a very important part. Any doubt till now? Any doubt? Any doubt, guys? Mancha, which one you are talking about? Budgeted figures? Where? Which one you are referring to? Any doubt, guys? No? No doubts? Okay. Now the report on the prospective financial information. We'll see one report. See, generally these reports are not available publicly. Okay, they are not available. But I am still trying to search. If I'll find one report, I'll definitely share with you guys. But as of now, these reports are used are prepared for specific cases and specific scenario. So I don't have a real life example of this particular report with me. Okay. So what are the contents of the report on the prospective financial information? Okay. First, the title, as we already see. Then we title, addressee, okay, identification of the prospective financial information, reference to the standards on auditing applicable to the examination of prospective information, that will be SAE 3400. Then the statement that the management is responsible for the preparation of the prospective financial information and its underlying assumptions. A reference to the purpose or restricted distribution of the prospective financial information. Statement that the examination procedures, including examination on a test basis of evidence supporting the assumptions, amount, and other disclosures in the prospective finance projection. Okay. Then statement of negative assurance as to whether the assumptions provide a reasonable basis for the prospective financial information. So reasonable negative assurance, that too reasonable in a reasonable way. Okay, providing a reasonable basis. Okay, so it's a negative assurance that we are talking about. We are talking about negative assurance here. But having said that, negative assurance, we are talking about basically negative assurance plus reasonable basis. So kind of a moderate assurance we are talking about, because we are not saying that okay, we will be able to give you a positive assurance considering the prospective financial information. Okay, but having said that, we are at least providing negative assurance with respect to the reasonable basis, so that you know that whether the assumptions provide a reasonable basis or not. That gives me a moderate level of assurance. Okay, then I have a opinion whether the prospective financial information is prepared on the basis of assumptions and is presented in accordance with the relevant financial reporting framework. Okay, so presentation and disclosure of the prospective financial information and properly prepared based on the assumptions. Now, assumptions again, okay, can be two type of assumptions, and that we need to specify which kind of assumption is used where. Then appropriate caveats concerning the achievability of the results indicated by the prospective financial information, because we are not issuing an opinion that you know this prospective financial information will be achieved. No, we are not issuing that opinion. Okay, so we need to provide that particular sentence in our report that okay, we are not giving an assurance with respect to the achievability of this prospective financial information. Are you getting my point? So we need to specify that specifically in our report. Clear? Any doubt? Any doubt? Okay. Then the date of report, place of signature, and the signature. These are the three things that are required at the end of the report. So that was the report of prospective financial information. And the last is the documentation that we are required to do. So that is a detailed on the prospective financial information and a report on a prospective financial information. So the question is whether the scope of the information here will include budgeted figures. Now, budgeted figures include scientific examination of projection in the light of actual situation. See, budgeted figures, when I talk about, if you are talking about they are budgeted figures, okay, in that case, I will say that is an best estimate, okay, or a forecast, not a projection. So they will fall under the category of forecast. And yes, there could be a budgeted figures. Budgets are, you know, kind of a forecast only, basically. You prepare on the best estimate that will be the thing that the company is trying to do or trying to achieve. But again, we need to make sure if we are talking about budgeted figures, then uh, we need to make sure that you know it is with the appropriate accounting policies, underlying assumptions are disclosed, the intended use of the information, distribution of the information. Okay, all these things are required to be taken care when we are issuing an opinion on the budgeted figures. Any doubt? Now, again, our opinion can be qualified opinion. Our opinion can be, okay, adverse opinion if the prospective findings, the assumptions which are there, or the data which is there on basis on which the assumptions are made is not appropriate, is not accurate, or not accurate rather, it's not reflecting the correct picture. Let's say I have a data, okay, based on which I could derive this particular assumption, but management has taken some other assumption. In that case, I would say, okay, the underlying data, okay, is not providing a basis for a prospective financial information. The underlying information is not providing basis for the prospective financial information, or the assumptions which are taken are not appropriate in the scenario, are unreasonable. Remember what was our target? Our target was in when I talk about opinion, our target was this: whether management best estimate assumption on which the prospective financial information is based are not unreasonable, and in the case of hypothetical assumptions, such assumptions are consistent with the purpose of information. Tomorrow, if I identify that the management's best estimate assumptions that has a higher chances of occurrence are incorrect, are unreasonable, are totally hypothetical without any basis, they don't have any supporting, in that case, I will issue a qualified or an adverse opinion. Now, the qualification or the adverse opinion again will be based on the materiality, that what is the which amount or which part of the prospective financial information is being impacted, whether it's a material or not, whether it's material and pervasive or not. On the basis of that, I need to issue qualified or adverse opinion in the current scenario. Point number J, appropriate caveats concerning the achievability of the results indicated by the prospective financial information. Caveats means like, mentioning that we are not issuing an opinion that this financial information will be achieved, prospective financial information. So kind of, we are not vouching the accuracy of the forecast. That is the thing that you need to enter or you need to specify in your report. Any doubt, guys? Any doubt? No doubt? Caveat means yes, condition. You can say condition. You can say a kind of statement restricting the you know where this information can be used or what should not be understood from this information. Now that was with respect to SAE 3400. That's it. Pretty simple, straightforward. There's nothing much in this particular SAE because we are talking about examination of prospective financial information. Okay. And while performing the examination, we need to take care of these things. That is the guidance given in the standard that we need to make sure. So that is the SAE 3400 that we discussed. Clear? Now, if no further doubts, I want to start the next SAE, that is 3402. Again, a specific scenario with respect to assurance report on controls at the service organization. So we saw type 1, type 2 report under SA 402. Remember type 1, type 2 report when we are talking about SA 402. Now, In that case, we were talking about that while doing an audit of an entity, auditor may obtain type 1, type 2 report when there is a service organization in the picture. And the type 1, type 2 report can be provided by the auditor of the service organization auditor. Okay. Now coming on the other side of that particular arrangement, now we are the service organization's auditor. So SAE 3402 talks about how to prepare type 1, type 2 report. This SAE deals with the assurance engagement undertaken by professional accountant to provide a report for the use by the user entity and their auditors. Okay, on the controls at a service organization that provide us, that provide service to the user entities. Okay, so this SAE only applies when the service organization is responsible, okay, for or is otherwise able to make an assertion about suitable design of the controls within the service organization. Are you getting my point? This SAE applies only when the service organization is responsible for or otherwise able to make assertion about the suitable design of the control. Okay, suitable design. This SAE, however, does not deal with the assurance engagement to report on whether the controls at the service organizations operated as described, to report on the control at the service organization other than those related to a service that likely to be relevant to the user entity's internal control. Okay, as it relates to the financial reporting. Okay. So those are out of the purview of this particular engagement. Again, I'll explain in a simpler way. This only talks about suitable design of the control. I'm talking about design efficiency of the control. That's it. When service organization is responsible, okay, responsible for suitable design of the control. That's it. It will not apply in any other case. So type 2 report along with the design, it was talking about operating effectiveness. We will not be talking about operative effectiveness over here. We will not talk about operating effectiveness over here. Are you understanding my point? So it does not deal with the assurance engagement to report only on whether the control at the service organization operated at described. So we are not talking about operations, like operating effectiveness. To report only on controls as service organizations other than those related to a service that is likely to be relevant for the user entity's internal control. Means the controls which are not relevant for the user entity. Okay. For example, if service organizations has some controls with respect to its own processing, with respect to its own structure, data, financial reporting, something like that, which is not relevant for the user organization, user entity. Let's say, for example, there is a user entity. I'll just give an example. Let's say there is a user entity X that has given to service organization Y a contract to process payroll. Now in service organization Y, controls related to processing of payroll will be relevant for user entity. Okay, will be relevant for the user entity. However, controls related to procurement, or let's say fixed assets, or let's say cash in bank, will not be relevant. So these not relevant controls, okay, these not relevant controls are not part of SAE 3402 because these are not relevant for the user entity. Okay. So that is the thing that it says that it does not deal with the assurance engagement to report only on the controls at the service organization other than those related to the service that is likely to be relevant for the user entity's internal control. For examples, controls that affect user entities, production or quality control. So it is not relevant with respect to the financial reporting of user entity. No, it is not relevant at all. So this particular assurance engagement does not deal with that. Yes, so here it means that the user entity has outsourced some of the activities to service organization. The way we were seeing in SA 402. That is the same arrangement. We have a user entity, we have a service organization, we have a user auditor, we have a service organization auditor. Same topic, same thing. It's not different over here. The terminologies are also same. Any doubts? Any doubts? Again, there are two things which are out of the scope. Number one, this one which talks about only report on operating effectiveness. Only, only report on operative effectiveness means no report on design. So I cannot give only report on operative effectiveness, no report on design under this SAE engagement. I could give under any other standard which may be applicable, let's say for example, agreed upon procedures, but not here, not in under this SAE 3402. Okay. Number two, controls not relevant for user entities financial reporting. So if there is a control which is not relevant with respect to the user entities financial reporting, or they are not relevant with respect to the service which is being provided by the provided to the user entity, then that will be out of the scope. Okay, report only on the controls at the service organization other than those related to a service that likely to be relevant for the user entities internal controls. Means report only on controls which are not related. Means I am reporting only on controls which are not related, unrelated, or not concerning the financial reporting. Again, so this kind excludes report on controls relevant for user entity. So I'm reporting only on the controls which are not relevant. So that kind of report also is not under the purview of SAE 3402, because in both cases you have only, sorry. Okay. To report only on the operating effectiveness, to report only on the controls which are not relevant. That is not part of the assurance engagement over here. Then what is the part of assurance engagement? What is the objective over here? Objective is same that we discuss in type 1, type 2 report. Objective is same that we discuss in type 1, type 2 report. So objective of the service auditor here is to obtain reasonable assurance, whether in all material respect based on the suitable criteria, the service organization description of systems fairly represents the same as designed, implemented throughout the specified periods. That was the case in type 1 report. The controls related to the control objectives stated in the service organization description of its system were suitably designed throughout the specified period. Design effectiveness were included in the scope of engagement. The controls operative effectively to provide reasonable assurance that the control objectives stated in the service organization description of its system were achieved throughout the specified period. Okay. Again, so first, reporting on the description of its system fairly present the system as designed and implemented throughout the specified period. Okay. That is in the case of a type 1 report that was the same. Or a specified particular date. If it is not a period, then it's the date. The controls related to the control objectives stated in the service organization descriptions were suitably designed throughout the specified period or a specified date. Specified date was in type 1 report. Specified period was in type 2 report. So type 1, type 2 report they are talking about. And the third, included in the scope of engagement, were included the controls operating effectively to provide reasonable assurance that the control objective stated in the service organization description of systems were achieved throughout the specified period. Okay. Very important. So when the objective is to issue type 1, type 2 report, nothing else. Okay, so there is one doubt why the control other than service organizations are there. See, that is excluded. It does not deal with. So if a control is not relevant with respect to the service organization or user entity's financial reporting, they will not be part of my assurance engagement. I cannot include that in this assurance engagement. So it does not deal with the this assurance engagement or standard does not deal with to report only on controls at the service organizations. Okay. Okay. Controls at the service organizations other than related to the financial reporting. Other than related to the financial reporting. Any doubt? Any doubt? No? No doubt? Okay, if no doubt, then let's take a quick 10-minute break. Okay, after the break, we'll gather back and continue the session. Meanwhile, if you get time in the break, just read through whatever we have discussed till now. Okay, with respect to SAE 3402, so you will get a good clarity. Okay, let's take a quick 10-minute break. the topic. So we were talking about type 1, type 2 report and objectives of the auditor over here. Why auditor? Because we are the service auditor. Earlier we were the user entity auditor when we are talking about SA 402. Now when we are talking about SAE 3402, we are the service auditor. So we need to think from the service entities point of view, service organizations point of view, and their auditors point of view. So that's why the objectives are to issue type 1 or type 2 report. We have already seen and discussed type 1 and type 2 report in detail in SA 402. I will not touch upon that topic again, but that is the same. That is the same type 1, type 2 report that we are talking about here. Okay. Now, few things I just want to discuss here is how to proceed such an engagement. How to go with such an engagement. It's pretty simple. The way we go in other engagements, like we check for the ethical requirements. We check who is the management and those charged with governance. What is their responsibility? Okay. We make sure that we comply with the independence requirement. So, in the similar fashion, we are also required to proceed with this engagement. I will be using the term auditor. Reason because we are the service organization auditor, not the practitioner. I will use the term auditor, service organization auditor. So, how to proceed with this particular engagement? Similar fashion that we have seen in other engagements, like check for the ethical requirements, including independence. Okay, okay, determine what communication is required with the those charged with governance and management. Okay, kind of complying with SA 260, 265. Then discuss about change in the terms of engagement, acceptance in the acceptance and change in the terms of engagement. Okay, same like SA 210 that we talk about. Then we talk about assessing the suitability of the criteria. Now, in an audit of a financial statement, the criteria against which we evaluate the financial statement is a applicable financial reporting framework. In audit of a financial statement, the suitable criteria is the applicable financial reporting framework against which we evaluate the financial statement. Now, this is a financial reporting framework. This is a financial statement, and we verify against that this criteria. That's the applicable financial reporting framework. But in case of type 1, type 2 report, or in case of these kind of engagement, we need to determine what is a suitable criteria for the description of system. Okay. Sometimes it may be COSO framework, sometimes it may be ISO, sometimes it may be something else. So we need to determine what is a suitable criteria based on which the entity has designed its system, its control, and the operating effectiveness of the control. Okay. So assessing the suitability of the criteria. Okay. Now suitability means whether this criteria can be adopted here or not. And when I talk about criteria with respect to preparing the description of the system, evaluating whether the controls are suitably designed, and in case of type 2 report, whether the controls are operating effectively. You might have already read somewhere the type of control frameworks. Remember, do you remember something like that? Type of control frameworks? If anyone can give me some types of control frameworks. Some example of type of control frameworks, if anyone can give me. Anyone? No, type of control frameworks, not the type of controls I'm talking about. So basically, type of control frameworks, when I refer, I refer to COSO, COBIT, ISO 9000 or ISO 27000. Okay. These are the type of control frameworks based on which you design your internal control structure within an organization. Okay. Then determining the materiality for these kind of engagements. Okay. When you are determining the materiality, you need to make sure, or you need to check whether it's a type 1 report or type 2 report. Need to obtain the understanding of the service organization systems. Similar fashion. So I'll just write determining materiality SA 320, similar to SA 320, obtaining understanding SA 315, assessing the suitable criteria again goes to SA 210. Okay, accepting the change in terms SA 210, communication SA 260. Same concepts, there is nothing different. SA 200, compliance with the ethical and independence requirement, obtaining evidence regarding the description of the control. So kind of obtaining evidence by performing the procedures will give you SA 500 plus SA 330. Obtaining evidence regarding design of the controls. So understanding the entity and its environment, including internal controls, that goes with the SA 315. Obtaining evidence regarding operating effectiveness of the control. Okay. Designing the appropriate response for the assets risk, kind of, that was SA 330. Understanding the internal audit function. Again, understanding it is similar lines with respect to the understanding the entity. Okay. So you can say it goes to SA again 315. Asking for the written representations. Similar concept of SA 580. Subsequent events. (560). Similar. All things are similar that we have already seen in multiple engagement, multiple times. Okay. With respect to the requirement. There is nothing new over here except understanding the concept that how it is, how this engagement is different. How this engagement is different than others. Now coming to the reporting part. See, when I talk about reporting, your report will be type 1 report or type 2 report. Okay. It will be nothing else because the objective here is to issue type 1 and type 2 report and to perform procedures in order to gather sufficient and appropriate evidence to issue type 1 and type 2 report. So your report will be structured in a way which will give a, either it will be a type 1 report or type 2 report. So for example, a title, addressee, okay, identification of the service organization, description of the system, and the service organization's assertions, like, like type 1 or type 2 report is there. Those parts of the service organization descriptions, if any, that are not covered by the service auditor's opinion, which is not part of your report. Okay. Description refers to the need of complementary user entity controls, a statement that the service auditor has not evaluated the suitability of the design or operative effectiveness of the complementary user entity controls, and that the controls objectives stated in the service organization description of the system can be achieved only if the complementary user entity controls are suitably designed or operating effectively along with the controls of the service organization. In SA 402, remember, we discussed about the complementary control, means controls which are present at the user organization and which are assisting the controls present at the service organization. For example, let's say I'll take this example, payroll only, user entity X and service organization Y. Let me add a page. Okay, let's say I have a user entity X. Now this user entity X has a control. The control is that before processing payroll sheet received from service organization Y, an independent reviewer reviews and approves the arithmetic calculations and compares the payroll amount with previous periods. Okay. This is not a foolproof control, I agree, because it is not verifying it is not performing the recalculation or reperformance of the calculation. But to some extent, it is only looking at the arithmetic calculations and a trend analysis kind of. So I cannot say this is a full control, but kind of a limited, this is example of a limited complementary control to identify some small issues which might have been missed out by the service organization Y. So service organization Y will be having a detailed control that, okay, for example, whatever payroll calculation is prepared by a person will be reviewed by another person. So let's say this is the main control, service organization Y. So control will be payroll calculations prepared by preparer will be reviewed by manager. Simple control. Okay, preparer, maker, checker control. Now this control is like kind of, you can say, a main control which is there. Okay, primary control is there. And this complementary control is supporting this primary control. This is at the user entity. This is in the user entity. Now, the auditor of service organization will not be having access to this. Okay. If I talk about auditor of service organization will not have access to the control or the performance of the control at the user entity. So what he needs to do is he needs to make sure that in his report, he specifies that the description refers to the need for the complementary user entity control. That is that we saw limited complementary control. Okay. A statement that service auditor has not evaluated the suitability of the design. So he does not have the access to the limited complementary control. So he has not evaluated the suitability of the design or operating effectiveness of the complementary user entity control. Okay. But he's saying that, this particular user entity control, okay, is necessary or it can be, required to achieve the objectives stated in the service organization description of a system and can only be achieved if the complementary user entity controls are suitably designed or operating effectively. Means kind of a reliance placed by a primary control. So what he is saying is that primary control can only achieve appropriate results when the limited complementary control is also working appropriately. Kind of, we cannot only rely upon the primary control, we need complementary controls also. So that is the particular scenario over here. Then, if the service are performed by sub-service organization, the nature activity performed by the sub-service organization is described in the service organization description. So if you have a let's say user entity has outsourced to a service organization and service organization outsourced to some other entity, sub-service organization, then the description of that. Then identification of the criteria. Just now I told you, like COSO, COVID or whatever criteria that is being used. A statement that report, in case of a type 2 report, the description of the test on the controls, okay, are intended only for the user entity. Means this report is only for the user entity, not for someone else. Okay, and their auditors, not for other people or not for any other purpose. Then a statement at the service organization is responsible for preparing the description of the system, providing service by covered by the service organization description, stating the control objective, okay, and designing and implementing control to achieve the control objective. So responsibility of a service organization that we have already seen in a type 1, type 2 report. Then a statement that service auditor's responsibility to express opinion on the service organization description, design of controls related to the control objective, and in case of a type 2 report, operating effectiveness of those controls based on the procedures. Then reference to the SAE 3042 that you need to provide. Okay. A summary of a service auditor's procedure to obtain reasonable assurance, like what procedures you have obtained. Okay. Then how do you think that is sufficient, whether you have obtained evidence that is sufficient and appropriate to provide a basis for the opinion. Okay, and in case of a type 1 report, which does not include your design operating effectiveness. So if it is a type 1 report, in case of a type 1 report, you need to have a statement that the service auditor has not performed any procedure regarding operative effectiveness, because it's a type 1 report. Type 1 reports only talk about design effectiveness, not the operating effectiveness. Then a statement on limitations of the control and the type 1, type 2 report, whatever type of report you are issuing. Then you have a date of service auditor. signature and place of signature. That is a report that you need to issue. The minimum content of the report, type 1, type 2 report. This is pretty much same that we have seen in the type 1, type 2 report. There is nothing different over here. Any doubt? Again, this could have a modified opinions if your descriptions are not matching the controls which are present at the service organization, if the controls are not designed as per the criteria, if they are not operating effectively as per the designed criteria, then you can have a modified opinion which could be qualified adverse, or in case if you are not getting any audit evidence, you can still issue a disclaimer of opinion. Any doubt? Again, pretty much straightforward, simple, nothing difficult, just on the line of SA 402. How SA 402 is applicable on the other end side for the service organization, that is 3402, SAE 3402. Any doubt, guys? Any doubt till now? Any doubt? Any doubt, guys? No? No doubts? If no doubts, can we proceed ahead? Okay. Okay. So let's proceed ahead. That was the SAE 3402 that we discussed. Now the last essay for today is SAE 3420. Okay. Now this is again specific case. Specific case means I'm talking about assurance engagement with respect to compilation. Sorry. Sorry for that. So I'm talking about assurance engagement to report on the compilation of proforma financial information which is included in the prospectus. Okay. So proforma financial statement which are included in the prospectus. So if there is a compilation of those pro forma financial information, then yes, that particular auditor can issue report on that. Okay, and accordingly, that can become part of your prospectus. Okay. Now, for this particular standard, we need to understand few things. Number one, what is pro forma financial information? And number two, how report on the compilation can be issued. Okay. What is the pro forma financial information and how a report on compilation of that pro forma financial information can be issued? Okay. Basically, when I talk about pro forma financial informations, okay, pro forma financial information reflects kind of like it is a information, financial information only, but shown together with the adjustment to show the impact of an event or transaction of unadjusted financial information. Okay, so kind of you take a historical financial information, you pass and give effect of the adjustments, and on the basis of that you prepare a pro forma financial information. Okay, so adjustment to unadjusted financial information to reflect that the events have occurred or the transactions have been undertaken at an earlier date for the selective purposes, based on whatever adjustment are required. Adjustment required for the applicable financial reporting framework. Okay, if you are preferring that, compared to and its accounting policies, some adjustment required on the basis of that. Okay, adjustment that may be required with respect to if any business has been acquired or business has been divested. Okay, or like to show some adjustment with respect to an event that has occurred or undertaken at a earlier date selected for the purpose of illustration, something like that. Okay, and you add up that in your financial information and you prepare a pro forma financial information. Okay, so this is basically to show that what is the impact of a particular adjustment event that has happened at the earlier date on the financial information. Okay, kind of that, you can say kind of that. So impact of a particular adjustment, impact of a particular what do you say, event on the financial information, that is your pro forma financial information. You kind of prepare, okay, this is the pro forma, this would have happened or this would have been picture if I include my this particular adjustment. Okay, if I include my this event in the financial information, like how it would have looked into, kind of that. So again, when I talk about pro forma financial information, it is not the normal financial information, but a pro forma, kind of something that would have been there if this adjustment, this event would have taken place or have been given like kind of have been given impact in the financial statement. They are generally used in the offer documents. Basically, the pro forma financial statement are generally used in offer document to show the effect of a transaction on the financial statement of a company. If those transaction has occurred at an earlier date, for example, how the entity's asset liability would have been, would have been reflected or would have been at a position if I would have acquired this entity 2 years before or 1 year before. Okay. And then they provide notes to accounts and everything in detail. So they prepare a pro forma balance sheet, pro forma statement of profit and loss. Again, like these are, kind of adjustment affected financial statement, you can say. Financial statement where some adjustment have been provided based on some events or conditions. Okay. Now, when I talk about adjustments, I'm focusing on the adjustment. Why I'm focusing on the adjustment? Because that is something here, the crux of the particular engagement. Okay. So, pro forma financial information, which refers to the financial information shown together with the adjustment to illustrate the impact of an event or a transaction on unadjusted financial information as if the event has occurred or transaction has occurred or has been undertaken at an earlier date selected for the purpose of illustration. Okay. So if I just show you with a, some kind of equation, so I would have like pro forma financial information would be like financial information, let's say as on 31/3/23, plus I will give adjustments, past adjustments of event, let's say that has occurred or kind of an event that has not occurred on 31/3/23 but occurred afterwards, or it is yet to occur but I am giving impact of that event, adjustment of the event if that would have occurred before 31/3/23. Let's say acquisition of the entity. If I would have acquired the entity before 31/3/23, and what would be the financial statement at that particular point in time? Okay. So financial statement on 31/3/23 plus adjustments that give me pro forma financial information. And this is unadjusted. This could be your audited figures. This could be audited also. This could be unaudited. Both can be possible. Are you understanding my point? Any doubt till now with respect to this? Kind of a something limited review report, but here I am looking for the adjustment, adjusted financial information. Adjusted financial information. Yeah, it can be, let's say adjustment can be on the negative side, can be on a positive side, not necessary. But whatever adjustment it will be, it will be. So whatever adjustment it will be, it will be. Any doubt till now? Any doubt? Mhm. If you have any doubts, you can ask freely, not an issue. Okay, fine. Uh, I am as of now, if I am trying to get the example for this kind of report, because these are not the normal cases. Again, these are the cases of specific scenarios, where you have such kind of investment, divestment, and such kind of report is issued. Okay, so that is the thing. Basically, uh, but again, if I find, I'll definitely share with you guys such kind of report if I get. But having said that, these reports are basically, are a specific case and are not usually available in the public. Reason because these are related to, what do you say, uh, of a specific category where there is an acquisition or divestment. And till the time that doesn't happen, then, it becomes very difficult for the company, to reflect this in out in public. Okay. It is mandatory by regulator. Yes, it is mandatory by regulator. So when it becomes mandatory, okay, under there are regulations, SEBI regulations, where on an acquisition or divestment is made by the issue after the end of the latest disclosed financial year. At that particular point in time, it becomes to disclose this particular one. Okay. So in some cases, SEBI regulations make it necessary to issue this kind of statement. But there are certain categories, only limited categories, where the pro forma financial informations are applicable. Under regulation, there are some regulations, 2009 regulations, where this is the case. Not in all of the regulations. Okay. Can subsequent event also be pro forma financial info? Subsequently, any which way, like if there is an event, okay, of an acquisition or disinvestment or something like that, for which I'm required to give an adjustment as a management, then this will become part of your pro forma financial information, because that will become the adjustment itself. That will become the adjustment itself. Any other doubt, guys? Any other doubt? Any other doubt with respect to this? I want you to understand this particular concept, because everything is dependent upon this one. Everything is dependent on this one. Okay. Now, if no further doubts, let me proceed ahead. So, the objective of the auditor over here. Okay, if I talk about the objective of the auditor in case of a pro forma financial information, okay, will be to obtain reasonable assurance. First of all, to obtain reasonable assurance with respect to whether the pro forma financial informations, okay, have been compiled in all material respect by responsible party on the basis of applied criteria. So the applied criteria will be, given by the regulation or by the, you can say whatever on the basis of which they are preparing this particular criteria. So if the pro forma financial information has been prepared, then there might be some criteria based on which it has been prepared. Then whether it has been compiled in appropriate way in all material respect, that is the one thing, and to obtain reasonable assurance about that. So this is an engagement for the reasonable assurance, not a moderate, not a limited, but a reasonable assurance. Number two, report in accordance with the practitioner's finding. Okay. Now, when I talk about compilation of pro forma financial information, the responsible party here will be responsible to gather, classify, summarize, present all the information and illustrate the impact of the event on the unadjusted financial information. Okay. Now, for that, what they need to do is first they need to identify the source of unadjusted financial information. That could be your audited financial statement, that could be your unaudited financial statement. So, from where you are taking that unadjusted financial information. Okay. Number two, to make the pro forma adjustment, you need to identify the adjustment itself. Okay. Making the pro forma adjustment, identifying the adjustment for the purpose, for whatever purpose it is. And third, presenting the result of pro forma financial information with the disclosures. Means first identifying the unadjusted information, identifying the adjustment, making the adjustment, and then presenting whatever outcome it is. And presenting whatever outcome it is. Okay. Now, what is the practitioner's responsibility over here? When I talk about practitioner, could be, like it could be auditor, it may not be auditor, but I'm talking about as of now practitioner. So when I talk about practitioner, the thing is he has no responsibility to compile the information. Okay, the practitioner has no responsibility to compile the financial information. Rather, the responsibility of practitioner is to report whether compilation is appropriate or not. Okay, whether it has been compiled in all material respect or not. So my responsibility is not to compile, but to report on the compilation and to obtain reasonable assurance that that in all material respect the responsible party has compiled as per the applicable criteria. Now, again, as I said, this is a reasonable assurance engagement with a positive assurance statement in your report. Okay. So, what I will do is I will perform the engagement, keeping in mind that's a reasonable assurance. I need to gather sufficient and appropriate evidence, and I need to issue a positive assurance report. Clear till now? Any doubt till now? Okay. Now, what we need to do, describe again in brief pro forma information. See, so there are two type of things. One, pro forma information or pro forma financial information, that is a result of unadjusted financial information and adjustment of an event. That will give you the performer financial information. So take the unadjusted financial information, add upon the adjustment of an event, and the resultant is the performer financial information. Reporting to all stakeholders, since it is mandatory, may not be or may be. That depend upon the type of the engagement. Means why you are preparing, why you are reporting on the performer financial information, and why the company is preparing performer financial information. Are you getting my point? The question comes to why. Just a minute. Okay. Now, we need to understand steps involved in the performer financial information. Okay. First is engagement acceptance. Without going to the detail, I'm asking you question, because as of now we have discussed a lot of engagements, a lot of things. What you would cover in engagement acceptance case, like in with when you want to accept an engagement of a pro forma financial information, what things you will look into? Some examples. What matters you will look into with respect to the engagement acceptance when you are supposed to accept the when there is an engagement for the compilation of perform report on the compilation of performa financial information, what things you will look for? Some examples. Come on, guys. And I think now you have a appropriate information. We have discussed multiple times what to look for engagement acceptance, agreeing the terms, or before accepting the engagement, what are the matters we need to look for? Come on, try and give some examples. Come on, guys. What things you will look for when you are thinking about accepting the engagement? What matters you will think for that you need to look into? Okay, good Mancha. Good Suraj. What else? Think of essay 210. What things you discussed, or we discussed in essay 210. Now modify that and apply in this case of engagement. Good Charu, yes. Correct Mancha, yes. Correct. Come on, guys. What matters areas you will look into? Very good, Suraj. Yes, correct. Basically, it is same what we have discussed in essay 210 with some modifications. If I talk about it is similar. Okay. So the applicable criteria that are used by the responsible party. Okay. Number two, responsibility of a responsible party. So what is the responsibility of a responsible party? Okay. Then what is the law or regulation applicable? Okay. Then determine the practitioner has a capability and competency to perform the engagement. Like we have the capability and capacity. Okay. Uh, you need to identify with the responsible party that applicable criteria suitable or not. Okay. And whether it is misleading for the purpose which is intended. Okay. Evaluate the wordings of the opinion prescribed by law or regulation in this case, and whether the same is in alignment specified in the SAE or not. Then source of unadjusted financial information. Okay. Then entities historical financial information, if they have never been audited or reviewed, then you need to understand, okay, sufficient, like you are not audited anytime any and this particular entity, you are not engaged in any of the assignment with the entity, then sufficient understanding of the entity and its accounting and financial reporting practice. Okay. Understanding the entity, event or transaction or acquisition that requires adjustment basically. Okay. Agreement on the responsible party that it acknowledge its responsibility for the compilation, for adequately disclosing, for compiling, for providing the practitioner with all the information, okay, additional information that is required, or access to those within the entity that practitioner may think necessary to discuss or to conduct interview with, inquiry with, okay. And when needed for the purpose of engagement, access to appropriate individuals within the equity or business combination entity. So as I gave you the example that it's an acquisition or kind of disinvestment. So if it is an acquisition, then access to the personal of the acquiring entity and the entity which is being getting acquired, responsibility of that. Then framework for the assurance engagement, planning and performing the engagement, materiality, okay, understanding how the responsible party has compiled, obtaining evidence of the appropriate source of the unadjusted financial information. Okay, all these things are there that we have already seen multiple times with respect to the before accepting the engagement. Then you need to obtain evidence. So first you need to think about the engagement acceptance. Okay. Then you need to plan in the engagement acceptance. Again, I talk about SA 200 plus 210. Then planning for performing the engagement, SA 315, 260, 330, 500, written representations 580, forming an opinion similar way as a 700 series, 700, 705, 706, something like that. Okay. Here we will talk about planning and performing. Then we will also talk about impact of the existing events or something. If there is an estimate or something like that, we need to give impact to the accounting estimates and everything. And preparing the assurance report. Same. Along with 700, this will also be there. Plus you have SA 450, evaluating the misstatement. Similar. All things are similar. Nothing different over here. The practitioner shall determine the responsible party has extracted the adjusted financial information. Okay. So obtain evidence about the appropriateness of the proforma financial adjustments. In related to the unadjusted financial information, with respect to the adjustment, you disclose that events have been occurred. You need to see that it is consistent with the applicable financial reporting framework of the reporting entity and its accounting policies. Okay. You need to read other information in the prospectus containing the proforma financial information to identify any material inconsistency on the similar lines of SA 720. Written representations, let's say 580. Modified opinions, unmodified opinions. Modified opinions is when you say that, you have not received or you have not obtained the sufficient and appropriate audit evidence to show that that the proforma financial information has been compiled. When you say the proforma financial information has not been compiled in all material respect on the basis of financial and on the basis of applicable criteria, when it is not compiled, okay, when the proforma financial information is not compiled, not compiled on the basis of applicable criteria. Okay, in that case, you can issue a modified opinion. Now, the thing not compiled, that depends upon, how much degree of how much it is misstated. So if it is a materially misstated, but the misstatement is not pervasive, then I will not issue a adverse opinion. I will issue a qualified opinion. That subject to these things, proforma financial information is compiled on the basis of applicable criteria. But if the misstatement is pervasive, then I will say proforma financial information is not compiled in all material respect on the basis of applicable criteria. And when I have not received the sufficient and appropriate evidence or appropriate audit evidence, I will issue a disclaimer of opinion. Simple. If and also if management does not make appropriate changes that you request, withdraw from engagement. If withdrawal is not possible, then seek for legal advice or issue a opinion like modified opinion. A specific criteria of emphasis of matter paragraph in this case. Emphasis of matter paragraph means here why it is required to draw the user attention to the matter presented or disclosed in the proforma financial information, okay, which requires the adjustment. Okay, now you need to incorporate emphasis of matter paragraph to show on what basis the adjustments are being made, which is already disclosed in the proforma financial information's accompanying notes. See, whenever proforma financial information is being prepared, they will take unadjusted, they will pass adjustment, and they will give you proforma financial information along with the notes, and notes will contain what are the adjustments. So in emphasis of matter paragraph, you can point toward those notes or point towards those adjustments basis which the proforma financial information is being prepared. And then preparing the report. Again, on the similar lines that we have seen till now. Okay, you have a title, you have addressee, you have introductory paragraphs that identify the proforma financial information, source, period covered, reference to the applicable criteria, statement that the responsible party is responsible for compiling, like responsibility of the management, description of the practitioner's responsibility, a statement that it is engagement is as per the SAE 3420. Okay. A statement that a reasonable assurance engagement is it is a reasonable assurance engagement. Okay. To report whether this is the responsibility of the practitioner. Procedures that has been selected on the basis of practitioner's judgment. Okay. Then practitioner's opinion using one of the following phrases like proforma information has been compiled in all material respect on the basis of applicable criteria, or proforma financial information has properly compiled on the basis stated, then the practitioner's signature, date of report, and place of signature. So that is the report. Now there is a question: are we required to communicate with those charged with governance before withdrawing? Answer is yes. See, whatever concepts we have seen till now, with respect to modification, withdrawing from engagement, all will be applicable over here. So here, instead of those charged with governance or management, we call responsible party, who is responsible to prepare the proforma financial information. So practitioner shall discuss the matter with the responsible party before withdrawing from the engagement. So instead of auditor, in SAE 3420, what I will do is, so for me, I'll write it over here. For this purpose, auditor is practitioner. Okay. For this particular purpose, for this particular standard, it is a practitioner, and management slash those charged with governance are not but responsible party. So these are the terms I will use for SAE 3420. Okay. So I will use practitioner and responsible party instead of auditors and management. Clear? Any doubt till now? And then you have a documentation requirement that is there everywhere. Any doubt till now with respect to SAE 3420? Here, the important part is to understand what is the engagement about. The rest of the things we have seen multiple times. It will be same. Once you understand the engagement, apply the concepts, whatever you have seen till now for that particular engagement. Any doubt till now with respect to SAE, whatever we have discussed, 3400, 3402, 3420? What I want you guys to do is, after this lecture, go and read the chapter 11 again in full detail. Try to correlate whatever we have learned till now in other chapters with this only. You will find a lot of similarities with respect to the, all the things like accepting the engagement, planning, performing, gathering the evidence and everything. You will find a lot of similarities. If you will correlate with the other chapters, you will find same similarity. The only difference is understanding the type of engagement and how to apply the concepts what we have already learned in a modified way to these engagements. If your logic is clear of essay, trust me, if your logic of essay is clear from start to the end with all essays, including 800, okay, I don't think so you will face difficulty in any of the rest of the standards which are new. Any doubt, guys? Any doubt? So, guys, one, you read chapter 11 after the lecture. Number two, before next lecture, which is on 19th, okay, on the chapter 12, digital auditing and assurance, read chapter 12 because it's a new chapter for you guys also. Okay, we will be discussing in detail the chapter 12. Okay, what is the scenario? I will try to give you some real life example with respect to that of digital assurance. Okay, and we will be discussing in detail chapter number 12 in the next lecture. So I want you guys to read in advance. I'll just show you the chapter number 12 over here. Digital auditing and assurance. Basically, what we are going to discuss over here, we are going to discuss about the key features of auditing digitally and digital auditing. Okay, understanding the IT environment, usage of IT technology, cyber risk. Okay, emerging technologies in audit, automation in audit like RPA, AI. Okay, control consideration of auditing digitally, next gen audit. We are going to discuss a lot of topics which can be new for you. Okay, which can be like you might be seeing for the first time. Some tools I will try to show you, some tools which might you might not have seen till now. Okay, that will be the first time you will be seeing those tools. Okay, or I will try to show you some techniques, or that we use with respect to what you say, in automated audit. For example, using of RPAs, using of IT systems and software, something like that. Okay, then we'll talk about remote auditing in detail. Okay, data analytics techniques, ACL. I'll try to show you one script of the ACL. I'll try to show you the Power BI dashboard that we have. Okay. Then I'll try to show you, some other automated tools in the audit, that we have already. Use of AI in the audit. So as of now, it's a limited, but I'll try to show you for that. So something like that. We will discuss blockchain and everything in detail. So, but for that, I want you to read the chapter in advance in detail, so that when I will be discussing, I will not discuss line by line. I will discuss upon the concepts. I will discuss upon the key features of these particular topics. But you should have a reading before, when you come to the lecture. Okay. Read chapter 11, read chapter 12, prepare your doubts. And important part, please provide your feedback with respect to, whether you are liking the lectures, whether you need something more, whether you need something additional. I'll be ready to help you out. Uh, the question is, should we refer auditing pronouncement for this standard, especially because this is a new standard? See, if you have time, I will always suggest refer auditing pronouncement for all these standards, not for only this. Why? Reason because, as I told you, standard auditing standards pronouncement has to have two parts. One, the bare text, one, the explanatory material. When you go and read the explanatory material, be it any standard, it will definitely give you a good clarity. So if you have time, okay, then I would suggest to read all. If you have time, if you don't have that much time, then go to the study material first, and based on the available time, try to cover those standards from the pronouncement which you find difficult, or which you have a difficulty in understanding. But what is preferred is to refer all the pronouncement. Okay. So if no further doubts, guys, then thank you. Thank you for participating in the lecture. I'll see you in the next lecture. Thank you.